As a stock market investor, we have to endure a lot. And all this time we are supposed to keep our finger off that sell button. That is exactly why 90% of investors lose money in the stock market, and they all have the same massive problem that stops them from making money long term in the stock market. It is their own human emotion. US broker Fidelity actually did a study and found out that the best performing portfolios are from dead people. But fortunately, you don't have to be dead to be a good investor. So let's take a look at the common mistakes investors make. The first massive mistake beginning investors often make is listening to others when they decide to invest in a stock. It can be a friend who tells you that you really need to invest in Tesla because he or she made so much money with it. A post in one of the different investing groups that you're part of telling you Microsoft is a must buy right now, or someone on the bus.
People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market.
Or me, a YouTuber you don't even know, telling you all about Enbridge or Omega healthcare investors or Arbor Realty. All those people have good intentions, me included of course, but we don't know your goals, how much risk you can take, or your personal financial situation. Don't get me wrong. These companies are not good or bad investments. What makes them good or bad is if they fit you and you understand them. But you just started investing in different stocks and you don't want to become part of that 90% of people losing money in the market. Fortunately, there are a few easy ways to fix this. The first way is to educate yourself about investing. When I started in 2017, I started with a book called The Single Best Investment by Lowell Miller. A good read and an easy to understand book about different growth investing. This will teach you how to do your due diligence on companies. But what if you don't have time to do all that research? I mean, you might have kids running around, a wife who would like to spend some time with you, a 9-to-5 job, and so on. But you still want to make money in the stock market because that non-existent interest rate on your savings account won't make you financially better off anytime soon. There's an easy way out. It is investing in an index or exchange traded fund, ETF. I have heard good things about SCHD as a dividend investor. Damn, I just gave you another one of those hot stock tips. Don't forget to do your own research first. Besides listening to other people, beginning investors, especially dividend investors, often make another mistake that could cost them dearly in the long run. They chase high dividend yields. And this is actually one of the most hardcore beliefs to get rid of. I mean, who doesn't want that 15% yield, right? That is a 15% return. Guaranteed. Except it isn't guaranteed. Yields are high for a reason, because the market sees a lot of risk with that particular stock, and it often does not end well. On October the 26th of 2021, I released a video called Don't Make This Mistake Buying Dividend Stocks, in which I showcased Orchid Island Capital, or ORC, which at the time was yielding around 15%, paying out 6.5 cents in dividends, at $5 per share. Fast forward to today, not even half a year later, ORC has just announced a 15% dividend cut in January, and the share price is down 25% since that video. And I got quite some comments on this video. That is why I say it is a hard belief to shake. I'm absolutely not trying to have a I told you so moment here. Instead, I want you to think about what happens with your own hard-earned money in a situation like this. Your $10,000 investment would have dwindled down to about $7,500, and you got fewer dividends instead of more. And that is not even the worst part, because this will have a big long-term effect on how much money you will make in the future. The solution for this mistake is straightforward, yet easier said than done. Don't chase high dividend yield stocks. If yield is above 10%, heck, even above 5%, it should raise red flags and you should figure out why. There are definitely some stocks that offer higher yields that I personally have faith in and have invested in, but I have researched those companies. And all those companies have the same things in common. They have long track records of increasing dividends. They keep making more money, shown by increasing revenue and net income. They have a durable competitive advantage or moat, and they have growth drivers to keep driving their profits up. Timing the market. Another mistake that is common yet often misunderstood. But it could cost you a lot of money. The reason I say it is often misunderstood by beginning investors is because it can come in many forms. You might be anxious to put your money in the market on yet another red day, or you think you know for certain that the mother of all stock market crashes is coming, so you cash out part or all of your stocks so you can buy back in later. Or you hold some cash on the side to invest when the market dips. These are all forms of trying to time the market. And they are all just as detrimental to how much money you will make in the stock market. Look, I know how it feels when there's a crash and you don't have any extra cash on the side to take advantage of that dip. It sucks, especially with a quick crash like we had in 2020. The best way to look at market timing is a famous example of 3 people who each invested in the market for 40 years, investing $200 per month. We have Tiffany Top, who had the worst market timing and invested all her money each time the market was at its peak, and in the meanwhile held her cash in a savings account earning a 3% interest. Those were the days. Then we have Brittany Bottom, who had impeccable timing and invested at each market bottom. And then we have Sarah Steady, who just invested $200 each month and didn't care what the market was doing at that moment. She crushed Tiffany Top by accumulating almost $1.4 million. Not even experts know when the market has hit its peak or bottom, even though you see some experts try to call it every day, because fear makes news. The best way to combat this mistake is probably pretty clear. Just invest a steady amount each month and you will come out on top. But the most prevalent mistake in the last few years must be this one. I only have to say GameStop, AMC, Tesla and crypto. And you probably know what I'm talking about. Fear of missing out, or FOMO. And it is very real. What do you feel when you see or hear that Bitcoin gained 2700% in the last 5 years? Or when someone like the Dogecoin millionaire buys Dogecoin and becomes a millionaire and at one point even had over $3 million worth of Dogecoin? And then you have the S&P 500 who only gained 83% in the last 5 years. You don't want to invest in boring stocks, right? You want to get rich and you want it now. Don't forget that FOMO often leads to steep losses. I don't have to tell you that if you invested in GameStop or AMC at the peak of the market, and then it came crumbling down. Or the Dogecoin millionaire, with his 3 million who isn't even a millionaire anymore. It seems obvious in hindsight, but it is so hard not to take the leap when you see others making money hand over fist, because they jumped in at the right moment. So how do you resist that if you want to become financially free or retire before you turn 40 or 50? This one is easier said than done. But the best way I know of to resist this temptation is to think of investing as a long-term game with no free lunches and to ignore social media as much as you can when it comes to these quick wins. What usually goes hand in hand with this behavior is that beginners often don't know their risk tolerance. Everyone is a big boy or girl who think they can take 30, 40 or 50% losses until you're in the middle of it. You don't know when or if it will end. But who am I to talk, right? Well, when it comes to the stock market, I can say I've been through the 2020 March 30% crash. And what did I do? Nothing, I just invested my monthly contribution as usual. I was an online poker professional in a previous life as well, where I had to endure 20 or 30% declines in my portfolio in one day. And still, I don't invest in the risky investments I mentioned before. Enough talking though. Let me show you what consistent investing can bring. $18,803, 50% gain including dividends, and $490 in dividends for 2021. Those are the raw numbers of my portfolio, but it doesn't tell the whole story. It doesn't tell you what I did when the market crashed, if I tried to time the market by holding some cash, or if I had FOMO at some point and got into GameStop and then got out with a loss. Little spoiler, I didn't. But Tom, the S&P gained 47% in 2021 alone. You are a little behind, aren't you? Yes and no. Remember when I told you not to listen to other people when you make your investment decisions? This is why. Because you don't know my goals or my financial situation. My goal is to have enough passive income before I turn 40, to be able to live off through a combination of dividends and other investments. I won't get that kind of dividends by investing in the S&P 500. Instead, I invest in companies like Enbridge, Omega Healthcare Investors and Store Capital, all paying higher dividends with some dividend growth for the most part. But I don't expect those to beat the S&P 500 on price performance. Instead, compare your progress to yourself. 1 year ago, my portfolio was at $13,600 and I made $364 in dividends in 2020. So progress. And if you want to get towards a life of financial independence, that is what you should aim for. Keep progressing. What should this teach you? To be patient and avoid the mistakes I've just told you about. You will reach your goal of traveling the world, retiring early, or just financial independence. whatever it may be. If you really want to reach that worry-free lifestyle and live off dividends, only avoiding these mistakes won't be enough. There's something else you should focus on as well to help you explode that dividend income stream. And that is why you really shouldn't ignore the dividend stocks I go over in this video.